Thank you so much for putting the paper in the program. I really appreciate it. And it's a joint work with Robert Bernhardt and Santiago Sordo Palacios, which are my research assistant, and now one of them is starting, Robert is starting the PhD at University of Chicago. Let me give you some background, because the Muni debt market is still not very much studied. First of all, is a very important source to finance the construction of the physical public capital, say water pipes or buildings. So it's really very important. It's very large. It's about, in the US, it's about 3.8 trillion. And is mostly investment grade, about 80%. And is characterized by extremely low default rates. It is mostly owned by retail investors, about 70%, and is exempt from federal income taxes. And often, if you buy bonds of the state in which you are residing, is also exempt from state income taxes, okay? And this is going to matter when we compare the spread to treasury yields, because we have to eliminate the tax advantage. But however, this market, starting mid-March, as many markets in the US during the COVID crisis, became severely distressed. There were massive outflows from the municipal bond mutual funds, which triggered fire sales, okay? So in few days, the muni spread to treasury for some states, like the states where I live, Illinois, which has a very bad credit rating, they spiked to 450 basis points, okay? And for some weeks, the issuance froze, okay, was very close to zero. And then the market focus quickly shifted to fundamental credit concern, because each state's expenditure related to COVID were going up, but revenues from taxes were going down, okay? So then, because of the speed and scope of the crisis, the policy intervention have been exceptional, okay? First of all, for the first time, the Fed decided to intervene in the muni debt market, okay, with the municipal liquidity facility, which is a facility in which the Fed were ready to buy up to 500 billion of short-term muni bonds, okay? Then at the same time, after 1 week, the Congress passed the CARES Act, which was a huge policy packet, about 2 trillion, and 200 billion were dedicated to fiscal aid, okay? And then also very importantly, the scope and duration of many unemployment benefits were extended, and they were not impacting the state unemployment account. So effectively, were extra income to states, also because many of these benefits are extra income and then can be taxed by the states. So why do they matter, this policy intervention? During budget crisis, the inability to finance and to issue and refinance debt at low rates may cause a growing deficit to become unsustainable and eventually to default, okay? And this would lead states, since most of them have to balance budget, to reduce expenditure and increase taxes, which means to reduce disposable income for individuals, especially when they need it the most during a crisis, okay? And then Halberbach et al. Have shown that during the previous crisis, the global financial crisis, this significantly slowed the recovery in the US. Eventually, this can also affect the entire US economy, because states account for about 11% of the share of unemployment and 11% of GDP and 13% to employment. So when we wanted to study the relative efficacy of fiscal policy and monetary policy in this market, we couldn't find any paper, okay? Because most papers just focus on a few monetary policy announcements, but didn't control for the fact that at the same time, there were so many fiscal policy interventions in the market, okay? So what we are trying to estimate is the relative efficacy of this simultaneous intervention, okay? And in particular, we also want to capture their persistent impact because some of these large fiscal aid took a while to affect the economy, okay? It is very important to keep in mind that we are focusing on only on the financial impact, I mean the impact on the spread, and so this is just the first leg of the transmission mechanism, and so it really does not account for the full effect, in particular doesn't account for the real effect, which in the relative comparison between fiscal and monetary policy can be more disadvantageous for fiscal policy because monetary policy is designed more to affect the first leg of the transmission mechanism, while fiscal policy usually is stronger on the second leg, okay? So how do we do this, okay? So the identification comes from the relative variation across states. We examined 20 states, which account for about 80% of GDP in the US. We have only 20 because not all of them have general obligation muni bond, and in particular, not all of them have enough bonds to derive a yield curve, and therefore to compare them to Treasury, okay? And we need a comparison to Treasury because the Treasury yields help us to control for everything else that is going on in the economy, so we're trying to capture only the effect specific to the muni debt market, okay? So we have daily variation in the muni Treasury spreads at different maturity, okay? And we try to explain them with the high frequency proxy of macroeconomic variable, okay, and public health conditions. And then we have the fiscal aid allocation to the states, and then we have the monetary policy announcement, and then we have key changes to state level policy, for example, the dates of lockdown or school closures and things like that, okay? Differently from event study, in the baseline, we focus on about 15 months, and then we do an extension to 22 months during the recovery period, because for the first time, the muni Treasury spread after May became negative. So we became very interested to understand how there's been this very strong change during the recovery period, okay? And then, using this coefficient, we estimate the counterfactual, meaning we ask ourselves what the spread would have been in the absence of fiscal policy and monetary policy, okay? And so these are the preview of the results. This is in particular the 3-year average muni Treasury spreads across the states, okay? In black, we have the actual one. In red, we have the one predicted by the model. And in purple, we show when we shut down both the monetary policy and fiscal policy. And the green area shows only when we shut down monetary policy, okay? So the green area shows the contribution of the fiscal policy intervention, and the blue area shows the contribution of monetary policy on top of fiscal policy, okay? First of all, you can see that the black line jumped at the beginning in mid-March to 450 basis points, okay? And we will see shortly that as soon as there is the first monetary policy announcement and the CARES Act announcement, they come down very quickly, okay? But while for the very good states, they stay down, for states with low credit rating, and especially states with very large cities where COVID was much worse, they start going up again. And so we will analyze all the effects. But the main message, which we find very interesting, especially because fiscal policy is not geared toward financial variable, is that the impact of fiscal policy is twice as much as the one of monetary policy. And at the longer term, this is, the impact of fiscal policy is even larger, which might indicate the fiscal policy addresses more fundamental credit concerns. Okay, so what are the innovative aspects of the approach, okay? First of all, as I said, the analysis is done over many months, okay? And instead of just using the day of the events, we also use the amount of fiscal aid associated to each state, okay? And so in that way, we can derive the price elasticity of the fiscal policy intervention, okay? And then we also control for high frequency proxy that became available during the pandemic. So for example, we use workplace mobility and open table reservation at restaurants for proxy for future economic condition under the assumption that, the lower was the mobility to the workplace, the bigger would have been the damage to the economy in the future. And same, the open table reservation help us to proxy for one of the sector, the leisure and hospitality sector, which has been hit the hardest during the pandemic, okay? And then we control for the positivity rate for COVID, a bunch of public health conditions, and the state level responses, okay? And the fact that we analyze the entire term structure help us a little bit to understand what is the channel of the transmission mechanism of the policy, because if the policy affected only the short-term yields, then we can conclude that it was mostly through the liquidity channel and through the elimination of the worst-case scenario, which is often called the risk channel, because this type of channel tend to affect only the eligible bonds, okay? And the eligible bonds, for example, at the Fed facility were only short-term, okay? But if the impact also was as strong or even stronger at long-term maturity, which were not eligible, so which means that the transmission mechanism went from eligible to ineligible bonds, then we would think that, the mechanism was mostly through the credit risk channel, because practically, if the policy addressed fundamental credit concern, then we should see the impact at the 5 and 10 year. Just a brief summary of the fiscal policy intervention and then of the monetary policy intervention. As I said, the first fiscal policy intervention was the CARES Act, and about 200 billion went to states. And the biggest part was this 150 billion for the coronavirus relief fund, okay? Then the funds were allocated based on the state population, but there was a cap of 1.25 billion per state. So this means that small states like Vermont were particularly benefit from relative to smaller states because of this cap. In fact, Vermont received 1.5 billion is 23% of their own resources, while New York only received 6% of its own resources, okay? And we got the allocation to each state from Auerbach et al. 2020. Then the important intervention were the pandemic unemployment assistance and the pandemic emergency unemployment compensation, okay? The first one extended benefit to freelancers, self-employed people, okay? And it was extended until September 6, 2021 under the American Rescue Plan, okay? Instead, the second one, instead of having unemployment benefits for 13 weeks, extended the unemployment benefits or other 13 weeks, and then under ARP, they were extended of 53 weeks. So practically we're extending over an extra year, okay? And the ARP was instead passed later in March 2021, 1 year later, and that one allocated even more money to states, about 350 billion, okay? And from this one, we got the allocation to each state from the House Oversight Committee. The monetary policy intervention started on the 23rd of March, when the Fed announced that some muni short-term notes can be admitted to other short-term facility, like the facility for commercial paper and money market mutual funds. And then on April 9, the Fed established the MLF, okay? That, as I said, was a primary market facility, so you could issue to the Fed at a certain rate, and the notes could be at the beginning almost 24 months, and then the facility extended the maturity to 36 months, okay? The problem is that at the beginning, the MLF was very restrictive because allowed participation only to city with more than 1 million residents, with at least 1 million residents, and county with 2 million residents. So there were a lot of states that were relatively more rural and which are also very poor that were excluded from the facility. And so after many complaints from these states, the Fed did some extension to the facility on April 27th, and so they reduced the population threshold for the participation of a city and different counties, okay? And they also extended the maturity of the notes, and they also allowed anything that was investment grade, but up to April 8th, and even if they were subsequently downgraded, as long as they were investment grade by April 8th, they were still allowed at the facility. Then on May 11th, they announced the spread, the pricing, and so the pricing was at the OIS rate of this maturity plus a spread that depended on the credit rating of the states, okay? And so this credit rating, for example, for state of Illinois, which is one that is the worst, it was 350 basis points. So these spreads were kind of, they were perceived by market participants as punitive. And that's why the facility has been always considered a backstop. So they really didn't want you to go to the facility unless it was really, you were really, the state was, or the city or the county was really in bad condition, okay? And then on August 11th, they reduced the spread by 50 basis points, okay? Just to give you an idea, for example, the blue line is Illinois, okay? Which is triple B minus, okay? The lowest graded admitted at the facility. And the red line is Minnesota, which is a AAA, okay? So you can see the dotted line are all the monetary policy announcements, and the solid line are the fiscal announcement. And so you can see what I was mentioning before, that as soon as there is the first announcement on March 23rd, all the spread keep going down, okay? But while the red one, the high credit rating one, stays down, the blue one starts going up again, because the market gets really concerned about big states like Illinois, New York, where the expenditure related to COVID and unemployment was so high, and the revenue from taxes and transportation were really coming down, okay? And as you can see, the horizontal line showed the spread at the facility. So you can see that for states like Minnesota, it made no sense to go to the facility because they could already access the debt market for much lower yields than the facility, okay? But at the beginning, for states like Illinois, you can see that the yields in the private market was above the facility. So in that case, it would have made sense to go to the facility to issue there, okay? But then very fast, it came down. This is the specification by state, okay? So we regressed the spread between muni and treasury yield relative to fiscal policy, monetary policy, and the macro control, and the state level responses, and the COVID-19 variable, okay? And I'm gonna skip the data description because I don't have enough time. So these are the baseline results for short maturity, okay? So these are the maturity that were up to 3 years, you were allowed to issue to the MLF, and for a year you could not. So we thought that it was interesting to show this 3 maturity in case there were some discontinuity between the 3 and 4 year, but you can see that the effects are quite similar between the 3 and 4 year, okay? So first of all, you can see that a change of 1 notch in the numerical credit rating. So if your credit rating went up of 1 notch, your yields, your spread to treasury would go down by about 50 basis points, 46, 47, okay? Workplace mobility and the open table diners also, the higher are the mobility and higher are the reservation, the lower is gonna be the yields, okay? And then all the fiscal policy intervention, the CARES Act, ARP, all the unemployment benefits, they all have the negative sign. So the more aid you receive for the fiscal policy intervention, the lower is your yields, the higher are the unemployment benefits, the lower is your yield, okay? The MLF announcement, overall, they reduced the yields by about 66 basis points. But you can see that while some announcements have a negative sign, some have a positive sign. So some of the announcements were like disappointing relative to market expectation. And these are in particular the extension of 27th of April, which was not considered sufficient, and then the reduction of 50 basis points, which happened too late because already all the private yields were below the spread of the facility. What is interesting is to notice that while the MLF announcement impact are quite similar, are short and long-term maturity, meaning they mostly work both through the liquidity and risk channel. The fiscal policy, in particular in the case of the ARP, they increase a longer-term maturity, while instead the CARES Act decreased a long-term maturity. That makes a lot of sense because the CARES Act was an emergency measure, okay? So it was expected to affect the economy and therefore the yields over a short horizon. But the ARP, which is the one passed in March 2021, so after the crisis, was thought as affecting the economy for a longer term, and therefore it affected longer term yields by more. Which means that probably it addressed fundamental credit concerns of the states. So I already showed you the counterfactual, okay? So at the 3-year maturity, you can see that while fiscal policy accounts for about 160 basis points, monetary policy is for 65, so about fiscal policy potency is about twice as much as the one of monetary policy, and their longer maturity even more so, because this fiscal policy accounts for 190 and monetary policy for 60. Then we do an extension to the recovery period, okay? And this is because, as you can see here, this is the yields, all the spread of all the states only for 2021. You can see that starting in June, they become negative. So at this point, this means that the state's fiscal situation is considered better than the federal government fiscal situation, okay? And this is the main reason is precisely the American Rescue Plan, because they receive so much money under the American Rescue Plan that the spread to Treasury become negative, which happened only once before in the 80s, okay? And so in this case, we show that practically the main message of the table is that what accounts for most of this effect are the coefficient of the ARP aid, because they become larger and larger over time, okay? So I already summarized this. The last analysis we do is by states' characteristics, okay? And we divide them based on population, partisan lean, meaning if you lean more Democrat or Republican relative to the median of the country, and also by credit risk, okay? And practically, the most important cuts of the data is by fiscal risk, which is measured by your credit rating before the start of the crisis, or which also we measure it by the loss in tax revenues during the crisis, okay? Because you can see that all the states that have lower than median credit rating, most of them are highly populated, and most of them lean Democrat. So once you control for fiscal risk, then if you also do the regression by partisan lean or population, you get the same result. And here the main message is that when you divide the states by low and high credit rating, which means that if you have a low credit rating, you are high fiscal risk, and if you have a high credit rating, you have low fiscal risk, you can see that the main message is that while fiscal policy is much more powerful in low credit rating states, meaning for higher fiscal risk states, monetary policy announcements were more advantageous to states that had higher credit rating, precisely because it was a backstop facility, okay? So to conclude, we showed the relative efficacy of fiscal and monetary policy, okay? And we showed that the fiscal policy at least accounts for twice as much as the monetary policy effect, okay? It is more effective at longer maturity, and is also more effective for the muni spreads of states with higher population density and lower credit ratings, okay? And, but what is very interesting is that we have to compare the cost, okay? While fiscal policy accounted for about 500 billion of expenses for the federal government, the MLF at the end is going to account for zero, because the MLF was only about 6.6 billion, and almost all of them have been already returned. Okay, so practically we are left with only the administrative cost of the facility for the Fed, and this is just because often just the presence of the Fed and the promise of being able to intervene very often buy you a lot of basis points. So what are the policy implications? First of all, probably the MLF being, in some sense, being the cost so low, but the impact quite high, about 60 basis points, tells you that maybe has been a good addition to the Fed policy toolkit, and that, of course, it can be improved because, for example, if some of the characteristics of the facility maybe were more similar to the corporate debt facility, right? I mean, from my point of view, I don't see why the muni debt facility has to be more punitive than the corporate debt facility. So, for example, the corporate debt was on the primary and secondary market, okay? And the notes were allowed to be of longer maturity. Maybe the MLF could have been even more effective. But of course, we don't want the MLF to be a substitute for fiscal policy. So it is clear that the fiscal policy intervention were more successful as they address the fundamental credit concern. But as I said, the cost matters.
Thank you very much, Luca, for including this paper in this session. I'm Andrea DePolis. I'm a PhD student at University of Warwick, currently at the ECB. And this is joint work with Leonardo Melosi from Chicago Fed and Ivan Petrella from the University of Warwick, and it's about the ever-changing challenge of price stability. So let me start with like a quote from Bernhardt in 2006. He said that monetary price stability plays a dual role in modern central banking. It is both an end and a mean to monetary policy, like trying to highlight how price stability, which is a fundamental concept in monetary policy, is not only like something that the institution must achieve, but it's something that it's necessary to make things work. However, like what we are a little bit concerned with is that, I mean, price stability, the concept of price stability really rests on a sort of a loose fundamental that is basically, in general, is thought of as moderate and stable inflation over the medium to long run, which seems like quite a broad and not very specific definition. And but in general, we also know that inflation is a very strange object. It's something that is very difficult to understand, and to our recollection, I mean, I think it's something that is hardly understood at this point. And this is because, I mean, we know from the literature, from research, that there are many different economic forces playing drugs and pulls on inflation, on the disaggregated component of inflation, and so basically on each component of price growth. And also we know that these different forces seems to exert like effect that can last over different horizons. So you can have like more permanent effect or more short-lived effects. So what do we know so far about how to model inflation, the inflation data, is that generally we need to exploit, in fact, like two main sets of data. So one is transitory factors that mainly relates to sort of these short-lived fluctuations that can, for example, like boost inflation over a very short period, which then reabsorbs quite quickly, and these typically relate to cost push factors or demand factors or something, or there is like a wide actually spectrum of these. And then we have long-term components, and these generally are mainly thought of being some unobserved inflation trends. This is, for example, the view a la Stoker-Watson, for example. Or this long-term trend can be, for example, extracted from surveys. So like the expectations of agents, for example, over longer horizons. And also, let me notice on this sort of what do we know so far in terms of modeling is that the majority of work, of current work, has been focused on the conditional Gaussianity assumption, even in the case of stochastic volatility. So most of the inflation modeling rests on the fact that, to some extent, like innovations to the process are Gaussian, and therefore, like they have all the Gaussian properties that we all know. So what is it that we do in this paper? This is really a modeling paper to start with. We take US core PCE inflation, and we use time series model to estimate its conditional distribution, and we employ skew T for this. This is something that is currently very used in some of the literature, but I want to stress that the real advantage of using this type of model is that in this case, if we want to model non-Gaussianities, these are allowed to exist, but they're not superimposed. So this is really letting the data speak about this feature. And what we do with this distribution, we estimate the time-varying parameters that then relates to the time-varying moment of inflation distribution. And to be specific, we model like a central scenario, something like the mode of the distribution, and then risk, the distribution of risk around it, which can be then possibly asymmetric if we actually find some evidence for time-varying asymmetry. And also, to sort of speak to what I just said before in the introduction, we distinguish between some permanent and transitory component to the model parameters in order to distinguish between what affects inflation over the long run and what is just like really a transitory effect. And in this setting, we also investigate a number of theories that can explain inflation movements. And to do so, we use long and short-term predictors or inflation dynamics. So I'll be more specific about it later, but we really want to see what drives like short-term fluctuation and what actually can sort of explain or talk to like the strong run movement. And so we try to identify over time the contribution of these different factors. And eventually we also try to analyze, to sort of give an overview of how one could think the optimal inflation policy when there is like an asymmetric risk outlook. By the way, I need to mention that this is the really first time that we present this paper, so any comment and feedback is really appreciated. Okay, so quickly, what do we find in case I run short of time? So inflation skewness are being varying over time quite a lot in our sample. And of course, like the high inflation of the 70s seems to give like a big push to skewness towards the positive side, which is what we want to expect. But then, like since the mid-90s, skewness has become more stable, staying closer, fluctuating more closer to zero, even though the long-term trend of inflation seems to have moved towards negative territory, and it has stayed there over the last 20 years. And this is something quite important that I'm going to work on later. So we find that, in line with some other previous research, we find that there are 2 or 3 key factors that shaped inflation over the different periods that we consider. In the last part of the sample, we know that zero lower bound spells actually exerts a negative drag to inflation, so they really keep inflation down, but especially this turns out in our model as like a push factor to like long-run skewness trend of inflation. So like it seems that this zero lower bound is really creating downside risk to inflation. But also we find like a primary role for fiscal policy, of course, as we all know. And this is true not only in moving like inflation skewness at low frequencies, but also like in general risk, because it is actually fiscal policy plays a big role also in taming inflation volatility. And we also, in this small exercise at the end where we show what happened in an asymmetric environment to optimal policy, in fact, we want to highlight that overlooking asymmetry can result in a severe mischaracterization of risk. And for example, to give like a practical example of what we do, we show that if one strays from fiscal policy, the fiscal policy effect on the distribution, one would find that over the last 20 years, we would have like a much worse inflation outlook than we actually have. So here I have a very small literature set. This is by no means exhaustive of what we do, but I want to really focus actually on the last part because this is the newest part of all. And so there are now, over the last few years, like more and more papers concerned with estimating the full distribution of inflation. That means actually trying to understand whether there is more to just like the variance to it. These papers mainly built on quantile regressions, so estimating like each quantile or as many quantiles as one wants of the inflation distribution with a completely different route to it. We use like an observation-driven model, which I'm going to show you in a second. Okay, so the first look at our model is very simple. We have a measurement equation where inflation at time t is given by central tendency, mu t, which is in general called the location, and then epsilon t is a set of innovations distributed according to a skew t distribution. Nu are the degrees of freedom, which in our exercise are kept fixed. So this doesn't mean that we don't have time-varying skewness, time-varying kurtosis, because this can move due to movements in volatility, but degrees of freedom remain fixed due to estimation issues. But then we have a time-varying scale, sigma t, and a time-varying shape, rho t, and these roughly relate to the volatility and to the skewness of the distribution. And we do have like a closed form solution for the likelihood function, for the log likelihood function of our model, which is going to be very important. And basically, I just want to highlight that this is like a skew distribution, but this is continuous. It doesn't have like a discontinuity like around the mode, as for example, one would expect out of a two-piece distribution, which is generally used for inflation. So we let these three parameters vary over time, and this will basically roughly allow us to estimate time-varying mean, variance, and skewness. How do we do that? Well, we place ourselves in the score-driven setting, so we will allow time variation in the parameters by means of the conditional score. What is that? For those of you who are not familiar with it, so basically I will give you just a brief introduction. So given a set of parameters, which in our case is this ft, which includes like the location, the log scale, and then a transformation of the symmetry parameter, because we want to ensure that the actual parameter lies within the unit circle. So given a parameter or a vector of parameter ft, starting from our left to right, we have first, as a main driver of the parameter at t+1, we have possibly some exogenous predictors. This is what I will tell you about in a second. An autoregressive component to give persistence to the parameters, and then st. And st is what we call the scale score. And this is nothing but the gradient of the log likelihood function with respect to the parameter of interest. So simply the first derivative of the log likelihood function with respect to the parameter of interest. And this sort of informs the updating mechanism of the direction in which we want to update our parameter to maximize a local fit of the model, like a conditional distribution of inflation, so to speak. And this is called the scale score because basically we scale this gradient by this function of the data, sort of st, and in our case, this is going to be the information matrix of our log likelihood, so that we also take into account the curvature of the likelihood function when we update. I mean, this might seem a little bit complicated maybe at first sight, but there is really a simple intuition to this mechanism, and that is that the scale score maps the prediction error into an appropriate meaning like feasible for each parameter update for the parameter of interest. And you can think about this in the case of volatility, for example, as a general version of a Garch, but then things become more difficult when one wants to, for example, update asymmetry parameters or something relating to skewness, because you would have like like big problems with massive realizations, because you would need to, for example, take higher order powers. This model, this framework has been proven to have very nice theoretical properties, and also in a previous paper we show that this exact formulation for this Qt actually seems to have very nice, performs very nice in tracking skewness only when it's present in the data. So we show in a Monte Carlo example that if nothing shows up, if data are not really skewed, then we would not pick up anything. I think there is a question. Can I take it now? Okay.
So one question about the model. So, like, but you cannot talk about the structural reasons for the asymmetry, right?
No.
So you can only, so
this,
is it CLD, or is it actually that the shocks are just asymmetric? That is something you cannot.
No, exactly. So we are not really trying to draw any sort of structural implication from this model. This is not the scope for what we do. But we can simply sort of try and see, we want to basically shed light on the fact that there is more to the Gaussian setting, and there is something that can actually drive that. We do not really go far into structural, into causality in a sense. Thank you. Let me just quickly also show you how do we do this long, short decomposition of the parameters. So the parameter consists is a linear combination of a short-term or a long-term component and a short-term component. The long-term component, this f hat, is basically a linear function of this x bar, which I'm going to talk about in a minute, and this f bar, which is really like a residual trend. And this is given by something which you can think of as being the non-Gaussian version of an exponentially weighted moving average. And then we have like a stationary component that is like a transitory component, which is a stationary filter with some distributed lag of some other predictive variables. And also in our estimation, we will employ some variable selection using horseshoe variable selection to basically aggressively shrunk to zero all the variables that we believe are not really necessary into explaining these dynamics. So let me get to the data and part of this predictor. So we model quarterly US core PCE inflation from early 60s to end of 2020. We did not really go into the latest data, but of course this is something that we are already planning to do. And all of this model is estimated in a Bayesian way. And we built like an adaptive Metropolis Hastings algorithm to get like really fast draws from the posterior distribution. Let me get to the predictors. So we take like a pool of predictors and we filter them through this Muller and Watson low pass type of filter. And so basically for each of the predictors we distinguish between like a secular trend, which is estimated over 10 years frequency, above 10 years frequency, and then the residual cycle, which is really the difference between this trend and the original variable. Let me give you a snapshot of what we mean by this long-term trend, which is really the novelty of what we do in here. So basically what we do is we estimate a model without predictors, so just inflation. We estimate some moments and parameters, and then we compute this long-run covariability a la Muller and Watson within the long-term trends of the moments and parameters and the long-term trends of data. And specifically here I report unit labor cost, the growth in unit labor cost in money growth, a measure of fiscal stance, and the long-run rate. And what you can see here is that despite not everything is significant, because there are some caveats which I'm going to skip, but there is like there seems to be like some correlation between, over the long run, between like what we estimate and this data. Let me also give a face to this very quickly. So for example, here in red, we have the estimated skewness of inflation, the long run skewness of inflation, and in black we have a measure of long run real rate. And what you can see is that the correlation seems to be quite interesting. But what we really do is to filter out like all the high frequency, and we really want to use low frequency component to inform our trend estimation. And we use the difference between these two lines to inform like a short-term component. Okay, let me go to the results. Here, I want to show you like what we estimate in terms of mean and volatility of inflation. In these plots, you see two curves, what we call the full moment, which is the sum of the two components, and then in red, I only isolate the permanent components of the long-term trend. Here, if one looks at the mean, if you're familiar with the Stock and Watson model, you can see something that is really different here. In Stock and Watson, like the trend really picks up all the movement of inflation, and there is a very small role for the cyclical component. While in our case, also due to the predictors, we see that the trend is like smoother and it does not really fit the data at each point, but there is like a lot of space to the cyclical component, at least for example, here in the 70s and here in the 70s. And this evidence seems to be like, there is less evidence for this when we come to the 2000, where, as I said before, like inflation stays a little bit closer to the target and it doesn't seem to vary a lot. And here we have like time varying volatility, where really like the only comment I want to make is that really we can see like sort of the usual slowdown in the mid-80s, which is what one would always expect modeling stochastic volatility in this frameworks. Sure.
Just one question on the permanent component. Like, what is it that buys you such high constant intervals in the trend? Is it the prior years on the
no. I mean, okay, the prior years on that might definitely help. There's no denying that. But I mean, if you have in mind sort of state space model, then you would have much wider confidence interval. But this is like really an observation-driven model. You don't have like sort of idiosyncratic terms for each of the components. And in general, I don't know, in my personal experience, I mean, like when you have like these sort of filtering methods, I mean, intervals are always very small. But perhaps it is due to maybe like in like prior self more than I expect. But from past experience, this is not really the case. I will look into that. Thank you. Here, and maybe this sort of makes you happier, we have skewness, time varying skewness, where we see that first of all, confidence intervals are a little bit wider because of course, we have like higher order moments to take into account. And it is very interesting to see that, of course, like here we have this very clear AMP shape over the 70s. So we have an extremely dominant upside risk to inflation. And this really goes down over the long run. This really goes down in the 90s. And it stays negative throughout all the 2000s, basically, implying that there is a higher downside risk to inflation than an upside risk, despite what you can see, the full skewness, which is what really moves the conditional distribution, tend to vary a lot over time, and especially in the last part, I mean, we do have positive episodes of positively skewed distribution. Okay, very briefly, because I might be running out of time, so this is like a table, actually a plot where we show like the relative importance of each of the variables that we use as predictors over the short and the long run for the location, scale, and asymmetry or shape parameter. Just to give you an idea, without me diving into that too much, like for example, here we have the unemployment gap and we recover like the usual Phillips curve type of effect over the location, so the central tendency, which what the Phillips curve is really concerned about, and we see like more muted effect over the short horizon for the higher order parameters. But what is really interesting is that there is a lot of sort of correlation between like what we estimate, the parameters we estimate, and what happens in these long run predictors that we use, that again are the growth rate of labor cost, a measure of fiscal stance, money growth, and the long-run rate. Let me get to what drives inflation risk. So here we have the decomposition into the predictive component, into what explains basically the time variation of the log scale. So this is really the long-run scale, and this is the unconstrained long-run asymmetry component. And what we find interesting here is to see that unit labor cost plays a key role here in the 70s, and then like this inflation starts being explained a lot by like a clear reduction in the long-run rate. And when we get here, we see that, for example, fiscal policy starts to play like a very interesting and important role into shaping the long-term risk outlook to inflation. And for example, we see that here, like around the like mid-2000s, basically we have an inversion into the role of fiscal policy when we go from sort of like more conservative fiscal policy to more expansionary fiscal policy. Okay, very quickly, how should one think about optimal policy in an environment? There is risk, as I just showed you, so there is asymmetric risk varying over time. So one can think that the central bank has this very general loss function where DR and UR are really downside risk and upside risk, which I will define in a second. And despite, and basically one can solve this problem very easily. This is really a stylized problem where basically we want to equate, we want to try and minimize the distance between upside and downside risk. In the most general and easy case that one can think of, when we have quadratic loss and the weight is equal on both sides, the central bank will really try to balance out upside risk and downside risk, and the optimal would be like, of course, to set the expected inflation to the target. And this is exactly what we all know, because this is true when F, so the distribution of inflation outlook, is symmetric. This is always the case. However, if F is asymmetric, then this equality breaks down. We don't really know what happens here, because if we really sort of target a central scenario, we are not considering the fact that an asymmetric outlook would give more mass to maybe deflation, to sort of more mass to downside risk than to upside risk, or the other way around. And so basically what one needs to do is to take into account what happens in the higher order moment when one computes the expected inflation. So skewness like sort of tilts expected value, and so if one wants to solve this problem in the usual way, then one needs to consider a function of this. In our framework, actually, we have a closed form solution for this one, but I'm going to skip it because I'm running low on time. So this is an estimated balance of risk implied by our model. The balance of risk is simply like the difference between upside and downside risk. And this really resembles, of course, tracks inflation, as one would expect. We have like really high upside risk in excess of downside risk in the 70s. But what is interesting is that this really is like steadily going down, and it really becomes negative after 2010. But to make the point I just made, I mean, what would happen if we did not include asymmetry in our model? Well, this is what we would estimate, and the dots really tracks the median of what I showed you before. And you can see that here we would massively miss on a lot of high upside risk, and most importantly here, like downside risk would, like balance of risk would be really like around 0, but when one considers asymmetry, we do really see like some downside risk to the inflation outlook. Last, I mean, we also I want to give you an idea of what, for example, like fiscal policy can tell us in this model. I mean, here we have the long run component of the balance of risk that we estimate over the 2000, and if one like overlooks, for example, the role of fiscal policy in trying to explain this balance of risk, what we would have, we would really see like a much more negative downside risk, so like a way more tilted balance of risk toward the negative side. And I think that this is something that is in line also with some of the research agenda of Leonardo. Okay, I conclude here. So, okay, I'll leave it to you. Thank you.
Okay, so as the session chair was saying, one paper was withdrawn, so it's now the final presentation. My name is Daniel Kaat, and I'm presenting the paper, A Household Housing Portfolio Channel of QE Transmission. And this is joint work with Dominik Boddin from Bundesbank, Chang from Fudan, and Alessandro Rebucci from Johns Hopkins. In a nutshell, what we do in this paper is we suggest a new channel through which quantitative easing can affect the real economy. And this is a channel that works outside the highly researched credit market. So the idea is that as the central bank purchases large amounts of bonds and the bond returns decrease, wealthy households start rebalancing their portfolio from bonds towards real estate. And this happens without necessarily borrowing. And this then pushes up housing prices and depresses expected future housing returns. And since housing has a large weight in households' portfolios, on average, the total portfolio return for households decreases, and this stimulates consumption through traditional channels. And then we bring the predictions of the model to the data using both regional data and household level data, and we find corroborating evidence. So why is that important? Well, I don't have to spend too many words on that here. So as you all know, after and during the global financial crisis, a lot of central banks have introduced new non-conventional monetary policy tools. This paper focuses on quantitative easing, so the large-scale asset purchase programs by the central bank. In the case of the ECB, there was also this negative deposit facility interest rate. That's not the focus of this paper, but we also have specifications where we look at the interaction between both. And quite quickly after the introduction of these tools, a lot of papers have looked at how they affect the real economy. But if you take a closer look at the literature, you see that most of these papers focus on the transmission through the credit market. So the idea is that banks have more liquidity after QE and they raise their loan supply. It's easier for firms to issue debt, things like that, and this generates real economic effects. But then a lot of countries in the world have been experiencing economic and housing booms in particular without credit booms. So the question is, how does QE affect the real economies in such what we call deleveraging environments? So we proposed this new housing portfolio channel of QE transmission that differs from the traditional credit and collateral channels. And just again, the idea is QE lowers the net supply of bonds, depresses their returns, the wealthy households rebalance towards real estate, and this also reduces the future expected housing returns. And this also drives down the total portfolio return for households. And one thing I want to mention here, because it's key for our empirical identification strategy, the model predicts that all of these effects are stronger in regions with tighter land supply. And I think that's very intuitive, because if there is more demand pressure because wealthy people start buying real estate, this should of course have a stronger effect in regions that are more constrained in terms of their land capacity. And we use this feature of the model so that the effects are amplified in regions with tight land supply to achieve identification in our region level analysis. In particular, we investigate whether QE raises the output growth differentials between regions that are more and less exposed to our channel, as proxied by land supply scarcity. And then we also have a part where we perform a household level analysis, which is based on the Bundesbank's panel on household finances. And here we, first of all, document that there was indeed rebalancing towards real estate. So wealthy people indeed buy real estate, in particular second homes. So this is consistent with a buy-to-let story. These people buy not their first homes to live in, but they buy them in order to rent them out. And then we show that this also spills over to higher consumption of these wealthy guys. So here two charts. I haven't mentioned it explicitly, but our empirical analysis focused on Germany. These two charts clearly show that this is a housing boom without a credit boom. So in the first panel, you see that after 2009, there is a sharp increase in housing prices and rents. And at the same time, the share of domestic housing credit to households has been declining. We can zoom in a little bit more into the household sector to see that, first of all, German households have the majority of their wealth invested in housing. That's not too surprising. It's the same as in other countries. But there are some striking differences to other countries. First of all, we see an increasing ratio of real estate to bonds. And note that this holds after controlling for valuation effects. So this is transaction driven. Leverage is low and declining during that sample period. We also see a low and falling home ownership rate, and that's consistent with this buy-to-let story, right? So obviously, if wealthy people start buying second homes in order to rent them out, this should imply a lower home ownership rate, something we see here. And finally, when we presented that paper in the past, people told us, hey, you should also look at equity rebalancing. So do these wealthy guys also rebalance towards stocks? But the answer is no. So we have specifications in the paper where we look at that explicitly, and we don't find any quantitatively important evidence for that. And this is perhaps not too surprising because you see that in Germany, the share of equity to total assets is relatively low and stable during that period. So I assume that not all of you are German, so this slide wants to convince you that you shouldn't leave the room now because we think external validity is important here. So we argue that the German case is not unique. In contrast, only very few countries have household credit markets as large as in the United States, for instance. And this is consistent with a recent paper by Cerutti and co-authors that argue that housing booms without credit booms are not uncommon. Okay, so we focus on Germany because it's a very popular example of a housing boom without credit boom, and also because we have very granular data here, but we are convinced that external validity is also given. Okay, so just a very quick preview of the results. Theoretically, we built that housing portfolio model with segmented asset markets to guide our empirical analysis and also identification. Note that I will be very quick on the model today, so I really want to focus on the empirics. And then we find that QE has a stronger impact on output growth in regions that are more exposed to our channel, and this holds after controlling for a lot of well-known traditional channels of QE transmission. We then show that the effect is also economically meaningful, so there is a growth differential between more and less exposed regions equal to 1 to 3 percentage points during our sample period. And finally, we also show in the regional part that the mechanism is consistent with the model in the sense that it's all driven by a drop in expected future housing returns. And then we have this household level part where we show that there is rebalancing towards second homes and increases in consumption. Yep? No, this is QE. QE driving down bond returns, and because of that, inducing wealthy people to rebalance away from bonds towards real estate.
So you could lower the rates and our returns, and then you would have the same thing.
So obviously, we also check negative interest rates, so in a very similar setting, and there we didn't find any evidence. The reason being could be that this is a country, Germany, where deposit rates, also before the negative interest rate policy, was already at the zero lower bound. So there was no additional room for decreases in deposit rates, and therefore people didn't shift their wealth from deposits towards real estate. So that's nothing we find in the data. But I agree, potentially that could be a channel. And I would assume that in countries of Southern Europe, for instance, where the deposit rates were further away from the zero lower bound, the effects would also be driven by a rebalancing from deposits to real estate, but not in the case of Germany.
What you said, in the long term, let's increase too much with the negative rates?
Not in the case of Germany, because the deposit rates were already at zero, essentially. Yeah. Yeah. Yeah.
Lowers long-term rates on bonds, but it also lowers long-term mortgage rates, and it also lowers discount factors. And so, yes, there's a channel to bond wealth, but just the net present value of a fixed set of cash flows would also be more valuable. So even if bonds didn't even exist, in a world without bonds, reducing quantitative easing or such a thing could increase house prices.
Yeah. I agree. That's why we have specifications, I will get there, where we control for the mortgage interest rate and we don't find that they absorb anything. Plus, in the household part, we also look at what happens to borrowing of households, and it's statistically insignificant. So German households more exposed to QE, as measured by their initial bond shares, do not borrow more. So it's really not a credit story, but I agree with your point, yeah. So I will skip the related literature due to the interest of time. And then, as I said, just very quickly on the model. So we set up a representative regional household, we set up a simple housing portfolio model, and we have 3 agents in that model. The first agent is a wealthy household, and this is a wealth maximizer. So this household maximizes end-of-period wealth. We assume that he or she has mean variance preferences, and in our model we have 3 assets: houses, bonds, and cash. Okay? And you can think about this as the citizen of a German city. So this is a wealth maximizer that arbitrages across markets. And then we have 2 preferred habitat investors. So here we follow Vallanos and Villa 2021. And these guys only invest in a certain portion of the market. So there is a regional housing investor and there is a national bond investor. And well, once we solve the model, I have to skip these things. We don't have the time for that today. We show that as QE reduces the bond returns, households' bond holdings go down, bond prices increase. Households then, because of that drop in bond returns, rebalance towards real estate. And this induces an increase in the housing portfolio share that we also see in the aggregate data, but also in the household level data. Prices here increase as well, and the expected returns fall. And since housing is so important for the average household portfolio, the total portfolio return also drops, and this stimulates consumption and output. And as I said before, the tighter the housing supply, the stronger the regional return decline, and therefore the possible consumption and output response. And this final point is crucial for our empirical analysis because we do an identification by geographic variation strategy, expecting that, consistent with the model, the impact of QE on output growth is stronger in regions in which real estate supply is tighter. And we proxy for regional real estate supply tightness by using the share of land in a given region that is covered by water bodies and urban open space. And this is a variable closely related to other supply-side elasticity measures, as for instance used in size, Hilbert and Vermeulen, among a lot of others. Well, here are some tables showing that, and scatter plots that indeed show that tighter regions are more exposed to this channel, so they have lower expected housing returns following a QE intervention. But again, I want to skip these slides and talk a little bit more about the data. So we have a matched data set at the annual frequency that covers all 401 urban and rural regions in Germany. And these regions are in size comparable to counties in the United States. And there we have a lot of data on output, residential property price and rent information, land cover and land use data, etc. And we have 2 monetary policy variables in our analysis. So we proxy for QE by the size of the ECB balance sheet relative to total relative to GDP in the euro area. But we also use alternative proxies for QE. I will get there in the robustness section. And throughout all the regressions, we also control for the ONIA to capture the traditional interest rate channel of monetary policy transmission. Our residential price and rent data are from Bulwiengesa. This is a proprietary data provider that also supplies the data to Deutsche Bundesbank and the ECB, for instance. And you could ask the question, given what I told you before here, why do we need residential property and rent information? Well, the thing is, in our reduced form, we don't need it. But then I want to show you that the mechanisms are consistent with our model. And in the model, it's all about a drop in expected future housing returns. So the question is, how do you model empirically expected future housing returns? And here we borrow from Cochrane, who shows for the United States that current rental yields, or current rent to price ratios, can predict expected future housing returns. And we replicate his analysis using German data and find the same evidence. Okay, and that's why we need those price and rent information. So we construct the rental yield as our main mediating variable. These are the details for the Cochrane regressions, but I want to skip that. Yeah? Yeah, you could think that they use this higher collateral or wealth values to start borrowing. That's what we know from the United States, what happened. But this is not the German story. So keep in mind also from the... Yeah, so the interesting thing is, once we come to the household data, I will get there. But we show that the guys that buy second homes raise their consumption, potentially because, as I said before, they have a lower portfolio return, so there is a substitution effect that dominates the income effect, and they raise their consumption. But we also show that there is a pecking order, so people that sell their houses, obviously if someone buys, someone has to sell as well. The sellers also raise their consumption, but by less. And then people that owned real estate before the QE intervention and neither sold nor bought any additional units, they also raise their consumption. And only people that are not exposed to the real estate market at all, neither in the pre nor in the post-QE period, they reduce their consumption relative to others. So I agree, so our story is in the data, but I agree that other channels are also in there, but not for the wealthy guys, but rather for poorer parts of the distribution. Yeah. This is the reduced form where we regress regional GDP growth on our two monetary policy indicators interacted with exposure. And again, exposure is consistent with the model land supply tightness. And we control for regional and time fixed effects throughout. Column 1 and 2 show that both lower interest rates and more QE raise the output growth differentials between more and less exposed regions. Once we include both interactions at the same time, that's what we do in column 3, we see very nicely that QE dominates the interest rate effect, right? So Ionia interaction turns statistically insignificant. In column 4, we check for complementarity by interacting QE and Ionia with exposure, but we don't see any complementarity. So the effect of QE is there independent of whether the interest rate is higher or lower. And then in column 5 through 8, we control for other regional characteristics that might play a role in GDP growth differentials and might also be correlated with our exposure variable. But we see that this doesn't affect the statistical significance and also the economic significance too decisively. And in terms of economic significance, these estimates imply that more exposed regions, which we define as those at the 75th percentile of the exposure distribution relative to less exposed ones at the 25th percentile, for each one standard deviation increase in QE, grow 10 to 20 basis points more per year. And if you add that up cumulatively during our sample period, you end up with this 1 to 3 percentage point growth differential that I mentioned at the beginning. We do a lot of robustness, so we control for other macroeconomic variables like fiscal policy, financial uncertainty, immigration, etc. This doesn't play a big role, so our estimates stay more or less unchanged. We also use an alternative instrument to measure exposure to our channel. So instead of using land supply scarcity, we also use regional party affiliations because we can show that in Germany, especially the Green Party is more in favor of the rental market. So in regions where the Green Party is relatively strong, we see that the rental market is better working. And this, of course, means that their wealthy households have more incentives to rebalance towards real estate because it's easier to rent the apartments out there. And all of our results are robust. We also use different QE proxies. So instead of using total assets, we use total debt securities, and we also break them down into debt securities issued by private agents, government debt securities, and financial debt securities held by the ECB, all as a share of GDP. Again, the results go through. And finally, we also ran some spatial regressions taking into account the correlation between regions, right? If you have high growth, say in Cologne, it's also quite likely that you have high growth in Düsseldorf, but this doesn't affect the estimates either. We dropped some top growth regions because you could say, hey, Daniel, this is just a story of a few cities in Germany. But actually, no, it's not the case. So we find that even after dropping these high growth regions, our results survive. So it holds across the distribution. And finally, we also interacted our variables of interest with a negative interest rate policy dummy, which was again statistically insignificant. So in other words, QE has an effect on the output growth differentials independent of whether we are in a positive or negative interest rate environment. So all of these results are consistent with the model. But in the model, I talked a lot about drops in expected future housing returns. So of course, now you want to see that our reduced form results are actually driven by drops in expected future housing returns. That's what we do here. So in column 1, once we add the rental yield as a proxy for expected future housing returns, as I said a couple of minutes ago, we see that the QE interaction turns statistically insignificant. So this rental yield absorbs a lot of the QE reduced form impact. We then wanted to see whether other variables that we know from the literature can also affect the transmission of QE, have a similar absorbing effect. So we added the term spread, we added credit growth, the mortgage interest rate, we controlled for the national house price index. And you see that most of these variables also absorb the QE effect. So the question is, which of the effects are stronger? So is it our channel as proxied by the rental yield? Are it more the traditional channels, so the collateral and credit channels? So what we did is we always added the rental yield as the mediating variable for our channel, plus one of the other channels at a time. And what you see is that the rental yield always, so here we have a p-value of 11%, so more or less, we always get that the rental yield is negative and statistically significant, but all the other mediating variables are clearly statistically insignificant. And this suggests that the rental yield seems to absorb the majority of the reduced form QE impact. What we did in the next step is we predicted the mediating variables by QE, because the nice thing is once you did that, you can combine the estimates from this table that I've shown you before and these predicting coefficients to come up with a decomposition. So we have the details of this kind of exercise in the paper, so if you're more interested, please take a look at it. But what the takeaway is that if we combine these two sets of estimates, we get that about 60% of the reduced form impact that I've shown you before can be explained by a drop in the rental yield. And the remaining 40% can be attributed to the other channels, like the credit channel, lower mortgage rates, reductions in the term spread, or higher collateral values as proxied by national housing prices. We corroborate this evidence by a 2SLS specification, which is similar to Cheney and co-authors 2012 AR paper. So we regress GDP growth on the rental yield, now at the regional level. And we predict this rental yield variable by our QE exposure interaction. So in a sense, we want to understand whether QE affects output growth differentials across regions by lowering the rental yield in a region. And here are the results. So the first stage coefficient is as expected. So QE reduces the rental yield more in regions with tighter land supply. And we have a first stage F statistic larger than 10, so the relevance condition is satisfied. And in the second stage, we see that in regions in which QE reduces the rental yield more, these regions grow over proportionally more. Then we have some cross-regional analysis where we find that in regions of West Germany, in highly densely populated regions, and in wealthy regions, the effects are stronger. That's something you would have expected because in these regions you have arguably a larger number of wealthier households that can rebalance. So it's also consistent with the model to get this result. And then I want to spend the final 5 minutes to talk about this household part. And this is the latest part we added to the paper. So that's more or less still work in progress. We set up a household data set based on the Bundesbank's panel on household finances. And this survey comes in 3 waves, conducted in 2011, 14, and 17. And in each of these waves, you have about 4,000 to 5,000 households interviewed. And this survey has a lot of wealth data and also information about borrowing behavior of households, etc. And you also have consumption data, which here is calculated as the difference between income and net saving. And then we do a diff and diff specification. So in 2014, the ECB, 2014 and 15, the ECB introduced and reinforced its QE program. So we used the third and the first wave of the survey conducted in 2017 and 2011 and want to understand whether around this adoption of QE, certain households rebalance towards housing. Okay, so the main outcome variable is the housing portfolio share at the household level between the first and the third wave of the survey. And the main variables on the right-hand side of this equation are different household characteristics. Most importantly, we define 4 dummies, whether a household belongs to the top 25%, the upper medium 25%, the lower medium 25%, and the lowest 25% of the net wealth distribution. And we also control for a lot of other household characteristics like age, how many household members, financial literacy, risk aversion, income, etc. That's step 1. And the second step, we want to show you that households that are more exposed to QE indeed rebalance more towards housing. And here we measure exposure to QE by the initial bond share. So we assume that a household that before the QE intervention had a higher share of his or her wealth invested in bonds, whether they rebalance more. So we interact all of our coefficients or variables of interest with this initial bond share. And here are the results. So in the end, we see that the wealthy guys indeed rebalance most towards housing. And we see that the difference between the different wealth quartiles is stronger for second homes. So for total housing, we see this effect already, but it gets much stronger once we focus on second homes. So these wealthy people, they actually rebalance towards second homes. In column 5, we have this interaction with exposure as measured by the initial bond share. And you see clearly that if you are wealthy and you initially invested a larger fraction of your wealth in bonds, then you invest more into the real estate markets. So this is some of the consumption evidence where we just focus on the wealthy people for now. And as I said before, we are currently working on that, and we came up with this pecking order showing that not only the wealthy people raise their consumption, but also poorer people that owned real estate before the QE intervention. That's what I said before. But since this is still work in progress, I don't have a table on that. But what we certainly see is that those rebalancing households, so the wealthy guys, also raise their real consumption most significantly. And again, this effect is stronger for wealthy households owning a lot of bonds before the QE intervention. So let me conclude. So we proposed this housing portfolio channel of QE transmission and show its plausibility in a simple model with housing portfolios and asset market segmentation. And then we provide supporting evidence both using regional data and household level data. And here I want to stop and thank you for the attention.